Hello, everyone. Welcome to our video on introducing the balance sheet. The balance sheet is the first financial statement covered in Chapter 4. With the balance sheet, it gives us the fundamental accounting identity, which shows us that a firm's assets must be equal to the sum of its liabilities plus equity. All right. So you see the equation at the top of the slide. That's certainly something to burn into your memory banks. We always need to remember this throughout our business career. And so a couple of key things come from this. Number one, assets are shown on the balance sheet. Assets show us the dollar value of all of the firm's holdings at a given point in time. And that's why the balance sheet is often referred to as a snapshot or a picture of here's what our assets look like right now. So the asset side of the balance sheet will show things like the firm's cash position, how much cash they hold in their various checking accounts, how much do they hold in short-term investments, what do they have in inventory, what do they have in accounts receivable, what do they have in property, plant, and equipment, what do they have in intangible assets, such as the value of the brands, copyrights, value of the patents, that kind of thing. All right, so number one, balance sheet shows us our assets. Think of those as the items that the companies buy or acquire to produce future revenues. That's the whole point of having assets on the balance sheet, is to either produce revenues and earnings and cash flows, or the assets that show up on the balance sheet are outcomes of previous years' revenues, earnings, and cash flows. Okay, so one little tricky thing about assets is to know that as they appear on the balance sheet, they're reported at book value, not market value. Book value is what it costs the company to buy. Market value would be if these assets were auctioned off on the open marketplace today, what would they sell for? Book value and market value can be very, very different things. More on that throughout your MBA curriculum. Second key thing to note with the balance sheet is that once we know our assets, it tells us how we are financing those assets. And you have two, and I repeat, only two choices for financing. One is liability financing, which is when we're given credit by a creditor. Think of it as a loan. Not all loans that companies get, not all liabilities have an interest rate or a borrowing rate attached to them, which means that not all liabilities are actually considered debt. Okay, debt is a liability, is a subset of liabilities that has a very explicit financing cost associated with it. And think of liabilities as just the borrowings, the amount of borrowings that the companies has to facilitate operations and purchase assets. So you can have very short-term liabilities, such as current liabilities, things like accounts payable, amounts we owe to our suppliers or vendors, wages payable, amounts we owe to our employees if we're paying them twice a month, and they get paid on maybe the 15th and 30th of each month. Then on day 16, day 17, day 18, they've accrued some wages, right? And yet if we haven't paid them at the end of day 18 and we look at our balance sheet on that date, we'd say, hey, look, we've got a liability here of 3 days worth of summed wages. At some point, we have to pay for that. Liabilities are known as a primary claim on the company's assets, meaning that if the company were to go bankrupt and could not meet its short-term financial obligations, then the value of its assets will be sold in the marketplace through bankruptcy proceedings. The cash flow that's raised from those asset sales will then go to the liability holders, those creditors who have given funds to the company on a lending basis. That's what's called a primary claim. You have a primary claim on those assets. The second source of financing is known as internal financing for small companies, or it can be a combination of internal or external financing for larger companies, and that is equity. And think of equity as the value of assets above that owed to creditors. Equity is also known as shareholder equity or net worth. Net worth, and we'll see more about net worth in a moment. But equity, because it's the amount of the value of assets above that owed to creditors, it represents a residual or secondary claim for the shareholder. And so that's just saying that shareholders will get whatever's left after liability providers receive the amounts that they are owed from the disposition or liquidation of assets. So if you think about a simple balance sheet, let's keep let's do simple math here. A company's got $100 million in assets. If they have $60 million in liabilities, that then implies that shareholder equity is valued at $40 million. Simply put, 40 plus 60 gives me 100. And so if I have two pieces of that equation, then I can automatically, indirectly calculate the third piece. Okay. And so one of the fundamental ratios we're going to want to look at later is what proportion of my assets are financed with liabilities versus equity. Right. And as my financing mix starts to skew more towards liabilities, that gives shareholders and creditors alike a little concern about my ability to service my liabilities. Remember, the key with liabilities is that money has to be paid back. So the balance sheet is very helpful because it provides us some basic commentary on corporate solvency. Corporate solvency refers to whether a given company or firm is solvent or not. Solvency just refers to whether assets are sufficient to cover liabilities. Okay, so if you take the basic balance sheet identity of assets equal liabilities plus equity, just do a simple rearrangement. Move the L over. If you subtract L from both sides, you have assets minus liabilities equals equity. Okay, so no really hard math here, but this is an interesting way to look at the balance sheet because this clearly shows us what the shareholder's residual claim is. And it's reduced by liabilities, right? Because assets are listed at book value. So if I purchase assets of $100 million and their value doesn't change, right? Because we're not using their market values, but I incur more and more liabilities, more and more debts to finance my operations, my liabilities may go from 60 million to 65. That drops my equity, right, from 40 to 35 million. And so one of the key things to get from chapter 4 on balance sheets is the fact that equity, the residual claim of shareholders, is reduced by liabilities, and that causes shareholders to monitor the level of liabilities very closely. And that's important because we have to go to both credit markets and the equity market to raise financing. Assets are expensive. Okay. And when I want to raise equity financing, specifically what I'm looking at is I want to issue stock. When I want to entice a shareholder to buy my stock, I want to show them that I have as little as risk as possible so that they'll give me a higher price, higher valuation for that stock. And there's this basic tension between creditors and shareholders. Creditors just want the money they're owed back, plus interest possibly. Shareholders don't have a fixed claim on the value of the firm. They are worried about long-term growth potential of the value of stock and on dividends. And so for that reason, they want managers of the firm to make to take strategic risks that have high expected values. Creditors, or those companies or entities that provide liability financing, they're not worried about that. And so we can illustrate this solvency concept two ways. One is looking at the very basic Uncle Joey example shown in the chapter, which deals more with personal finance. It's a fine example. I prefer this alternate example on the right-hand side of the slide that you can look at here that I put together. Suppose we look at two different firms, firm A and firm B. Simple math here again. Both have liabilities of $150 million, but they have very different asset values. Okay? Firm A has assets of $100 million. Firm B has assets of $200 million. And so if you calculate equity using the assets minus liability calculation, you see something very important here, don't you? For the balance sheet equation to balance, for firm A, if it has $100 in assets and $150 in liabilities, shareholder equity is negative 50. Meaning equity holders, shareholders of the company, will lose everything they've invested in the firm. Firm B, on the other hand, has a much more manageable liability position. They have $150 million in liabilities, but their assets are $200 million. And so their shareholder equity is positive 50 million. And so that gives us a concrete example of insolvency versus solvency. Firm A is technically insolvent based on the balance sheet because its assets, if they were all liquidated, would be insufficient to cover its liabilities. Firm B, however, is solvent. And so this concept of solvency is monitored very closely by the credit market and by the equity market. And that's why we are concerned with this, because when creditors fear of insolvency for a company, they will charge higher rates for future debt capital, or they may not provide us lending at all. And shareholders will react similarly. They will see higher level of risk for a company that is deemed to be insolvent, which they might buy more shares from us, but they will buy it at a drastically lower price because we have more risk.